Hey there, traders, checking in on the S&P 500 and the broader market today. There was a big bearish reaction to headlines. We're going to talk about it. We're going to talk about what this means bigger picture because we have some pretty important earnings coming up for the tech sector. I'll show you why on the weekly time frames, and we'll go over the chart that I am watching in the short term for the S&P 500 futures, which is at a critical support test as we speak. See you in a minute. Hello, and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. So here's the chart I'm watching on the S&P 500 futures. It's the 4-hour time frame. You know I've been digging wedges in both directions recently. We had a falling wedge on QQQ that helped us watch the bounce. And we now have a rising wedge on SPX 500 USD, and we're watching it very closely. Shout out to Mod Step 2 who pointed this out on the 12-hour time frame. I like it better on the 4-hour chart. But I posted and talked about this morning, and this afternoon we were trading right up here at the high of the day, and I said, we're breaking out of this pattern. And I was about to go back to the chat room and say, well, bull break of this pattern, it's negated. And then I looked at the time and I said, well, we still have 2 hours left in this candle. Let's see how it plays out. In the end, smashed back down. And look at where the bulls are trying to bounce right now, right off that support. 41 minutes until the candle closes. And the overnight trading session is going to be all about this level for me and whether or not we can stay in this channel. I would prefer if we can, because it would stay crystal clear for me for perhaps another day or two as far as what to be looking at. Today was a very tricky day to be a trader. There is no doubt about that whatsoever. And let's look at SPY on the daily chart. So SPY, we had a bull break straight into a pullback. The most important support on a lot of names for me is the low of Thursday. For SPY, that level is 331.19. This morning was really tricky. The first hour of trading was just all inverse correlation between XLF and QQQ, positioning, swirling around of correlations, not really getting a whole lot of clarity. QQQ gave us a weak start, a very impressive V-shaped bounce to a new high of the day, and then pulled back from there. So I was sitting there this morning saying, I have no edge right now. And it's important that we as traders have a lack of ego. Because there's 3 ways that we can look at a morning like this morning. I could say, I'm confident and make a bunch of trades and lose a bunch of money because I'm kidding myself and wrong. We could say, I'm not confident. I forget what the third one was. But the bottom line is, you have to recognize and say, I have no edge right now. I have no idea where our short-term direction is headed. And I'm going to sit on my hands until I get that clarity. Because if I'm going to make a trade right now, I'm kidding myself to think that I have an edge. And that's where I was at this morning. Then started to get a little bit of clarity for the bears into the later morning. We ended up pulling back a bit. Then a big bull move into the midday during lunch. And then, of course, the headline hits. And this is the reaction to the headline. All out dump. Massive dump. And the headline, of course, forgot to mention it. Trump saying, we don't like Pelosi's deal. We're done negotiating. On to the election. So essentially, the market, which was now looking towards mid-October for when the Senate was going to reconvene and try and work out a deal, has now been told, nope, at the earliest, we're looking weeks later for anything on the stimulus deal. So essentially, in reaction to the headlines now, we have Trump's health sorted and priced in, and the only thing we can get out of Trump's health, in my opinion, from this point is a bearish reaction of him getting worse. And we now have the stimulus deal currently being priced in as a non-event for the next month plus, and it's not fully priced in because we haven't set a hard bottom and bulls haven't reacted enough to show us that they have priced it in now and we've moved off support. But once that happens, there will be no more bearish headlines in the near term about the stimulus. No more bullish headlines about the health, no more bearish headlines about the stimulus. And those headlines are going to be less of a factor. And then we'll be looking towards the mid-October debate. We got another one coming up in 9 days. Trump tweeted about that, so maybe it's still going to be on. But bottom line is, we are seeing the volatility that we know to expect as we head into the election from here. So, key Thursday support, key 4-hour rising wedge on the futures chart, and overnight, that rising wedge is what we're going to be watching. IWM had a beautiful start to the day, huge bull follow through, just V-shape to a higher high. Look at this monthly move. We just quickly bull flagged and broke resistance, but obviously no follow through on that resistance break. We had a top right under 160. We got up to 161, but closed at the low of the day. So plenty of space for a higher low to form. I talk about the low of Thursday being key for some names. Well, we're going to be looking at stronger names just looking at their last higher low. And for IWM, anything over 149, bulls are just fine. So plenty of space for a daily higher low to form here. So QQQ doesn't have nearly as much space. If we drop down and break the low of Friday, 273.44, we are then at risk of setting this weekly lower high. Tech sector earnings are shaping up to likely determine two very different scenarios. If we have bearish reaction to tech sector earnings, the potential of weekly confirmed downtrends, which tell us further monthly consolidation is coming, or if a bullish reaction to earnings, we're looking back at all-time highs. Those are two very different scenarios. So let's look at some of our major names right now. Amazon already broke the low of last week. Our weekly lower high is set. All-time high, low of the pullback, lower high, and now it's up to the bulls to hold 28.71 for a higher low. You can see the earnings are going to be the week of October 19th, and that's going to either determine a confirmed weekly downtrend on a bearish reaction or looking back at the all-time high, bullish. Apple did the exact same thing. Apple needs a little bit more bear follow-through. We did hold support, the low of Friday, 112, just barely, so it's not exactly the same. If we break 112, the weekly lower high has been set. Same thing. It's then up to the bulls to form a weekly higher low compared to 103.10 because the last thing any market bull wants to see is the tech sector confirming weekly downtrends. So that's what we're watching on QQQ and the major tech sector names. XLV, key daily support, low of Friday is 103.71. Still a little bit of space to work with, but have to be cautious. If that level were to break, our weekly lower high would likely be set. Financial sector, more space to work with. Anything above 23.73 holds that support. But again, from last video, the 2-week time frame, anything under 26.01 is just a lower high. So it is time for the bulls to try and defend this bearish reaction because again, we are teetering on the potential of confirmed weekly downtrends in the tech sector, and earnings are going to determine it. Biotech sector, bull break. At one point, at the high of the day, the biotech sector pretty much just had two resistance levels, 118.46 and the all-time high of 121.06. Not immune to the pullback. And we're looking at anything above 109.82 as a higher low. So again, you can see the low of Friday is the key daily support for the vast majority of individual names. One other thing that stands out today is as we saw the bearish reaction to this news and as fear hit the markets, correlations like that just synced up. The same correlations that we saw last time we had massive volatility on the way down with Corona, on the way up with the bounce. I'm talking bullish dollar, bearish gold, bearish Bitcoin, bearish markets. Oil saw some bearish action. So assets all went down on this tweet and the dollar went up. SMH, again, started the morning really strong. Now we're having to hold 173.08 for a higher low. Solar sector, bearish reversal candle, potential volume climax. I'm going to have a bear eye out tomorrow to see if there's a potential play for daily consolidation to begin. Holding on way better than most sectors, of course, at this point. And the VIX, still a tightening 2-day time frame. We would have to break 31.20 for that to change. And one note about the VIX, going to let Mr. Lawrence McMillan explain it. Elections 30 days out, keeping in mind the VIX is factoring in futures for the volatility index as well. And we're now going to be looking post-election, which means that will raise the VIX no matter what. And it's why the VIX is up today, even with the market ripping higher. And that, of course, was yesterday when that was posted. So just keep in mind that the VIX is now factoring in post-election volatility in its levels, prices, levels. So the dollar is bouncing today. And the question is this a weekly higher low being set on the dollar? We don't have nearly enough information. We have to see a clear trend change on the daily back to the bulls. Although I've been liking the 2-day time frame for gold. So look at the 2-day time frame for the dollar. And it just smoothed things out. You would say that we are still in a daily uptrend if you were viewing it this way. If you zoom into the daily, you could say, well, we had a little weak bounce attempt and then continued down. But if I'm using the 2-day time frame for clarity on a lot of these charts, like the Tesla equilibrium on the daily and gold and silver and miners, I may switch to the 2-day time frame on the dollar here. Probably going to do that, but I'll probably just flip back and forth between the daily and 2-day to see what gives me the most clarity. So if we're going to see the dollar confirm continuation on this bounce, that obviously increases the odds of a confirmed weekly downtrend in the tech sector. Gold, finally seeing a momentum shift. Again, let's go to the 2-day chart, and it's looking like our lower high is being set. If we see any bear follow through tomorrow, 2-day lower high is set, and we're then looking back down to 1848 support, and then I start establishing my game plan of where I want to scale in a position or two on GLD. So maybe I'm looking at 176.80 and another one at 174.80, and then putting a stop under 173 to see if the bulls are able to change the daily trend. Silver, 2-day time frame, looking like that lower high is potentially being set. A little bit more bear follow through would be needed, but clearly a bit toppy at the high of that bounce. Miners were crushed today. Why are the miners so much more bearish on today's candle than the metals? The answer is the miners are factoring in the price of metals and what the S&P 500, or I should say what the broader markets are doing, depending on what, in this instance, GDX, it's the NYSE. But the most significant moves for the miners are when the metals and the markets are going in the same direction. If they're both going up, we have big bull days. If they're both going down, like today, we have big bear days. There's been plenty of instances where they're inverse to each other. And that's when we know miners are not going to see significant moves in either direction if there's that tug of war going on. So both in the same direction are when there is the maximum move. So if I'm a miners trader, and I'm not, but if that's like one of my main focuses and that's all I'm doing every day, I am doubling the size of my positions when I am recognizing the market and the metals going in the same direction. That's when it's pedal to the metal. Anything other than that, and it's on the brakes a little bit, smaller position sizes, less aggressive, and that is how I would be approaching that sector. Oil, so a little bit of a pullback, 4-hour consolidation, just looking for a higher low. Nowhere near the dump that we saw in the markets overall, but 41.72 is a key resistance level, and we're topping out a bit under that level currently. And natural gas pulling back as well. Not a convincing bull break here. You want to break, you want to change the daily trend and see convincing follow through, and we don't have that right now. So looking at it on the weekly perspective, could this be a weekly bear flag? I would have to look at the retracements, but it's probably pretty close. We actually got to the 50% retracement. So that alone would make me look for at least a weekly higher low initially on any pullback. But we have a daily trend change with a lack of follow through. So bulls just a bit cautious because of that fact. And one factor in that is the more you pull back for that daily higher low, the bulls are now exhausted by the time they break resistance. If you pull back very briefly to set that daily higher low, it's much easier to see convincing follow through. So that's why size of consolidation and the amount you pull back is very important to be paying attention to, because bulls were more tired, obviously, breaking resistance from 190 than if we had pulled back and formed a higher low at $2. Just simple math. So I want to talk a little bit about hedging positions, because I've been posting in the chat room a few times about trades that I'm entering, about hedging positions. So I am a day trader. The vast majority of my capital is cash for day trading. I also have some long-term exposure. I've got SPY in my IRA with an average in the 240s that I entered on the way down in March. Just scaled in a couple positions. I definitely had more cash that I was going to utilize. I was not aggressively scaling in, but I was scaling in. So I have that position, and that's a no touch for decades position. I can't touch that IRA for 33 years, 34 years. I'll be dead by then. So not touching that position, but my account is going to fluctuate with that position. I also have USMJ positions, and they have some correlation to the broader market as well. So they dropped on this market drop as well. So when I have I'll just go through today's example. I had a solid day today where I made a day maker playing BA oversold bounces. I had a day and a half maker from my swing positions that I'm not touching right now. So not going to sell those and lock those gains in. And so I'm up 2.5 day maker. My account was a day maker away from all-time highs after climbing back towards that all-time high the past few days. And so I'm at that point. I say, okay, I'm mostly done trading for the day, and I'm going to be looking for protecting. I want to protect that 2.5 day maker. I don't want to give that back. And I know that if the market were to drop from here, I'm going to slowly be giving that back because my account is going to be dropping from my swing trading positions. So if I enter a bearish position similar in size to what my exposure is on the long side, I'm not having to sell any of my swing positions, and any pullback, my account value is going to stay relatively the same. So often, over the last couple of weeks, not often, maybe a few times a week, I will enter a small size to offset my smaller swing sizes of a hedge position. And today I chose QQQ, and I held it as long as we were rejecting from the high of yesterday. So today was obviously just a worst case scenario because we convincingly broke the double top at 280.50 essentially, and it then straight into the dump. So I stopped out of my hedge position saying, okay, bulls are proving themselves. Bulls are comfortable on a lot of time frames, and I am going to eat the small loss in my hedge, and my long position will benefit from any further upside. Then the headline hits 20 minutes later, and my account drops. So I ended the day with a half a day maker, giving back a 2-day maker from my long positions, notably dropping from the high of the day to where we closed. If I was not stopped out of my QQQ position, I would have ended the day with a 2.5 day maker. So I'm essentially locking in my gains on the day and keeping my account value stable. When I'm entering a hedge position, my number one goal is not, I want to profit on this position. My number one goal is, I want to lock in my account where it is right now and not see it drop on any market drop. So that's my mindset on entering small hedge positions to offset my long exposure. And this is new for me this year in the sense that I've never had a no-touch multiple decade SPY position. And I've had swing positions before, but I've never consistently had long exposure to the market because I don't trust our financial institutions. I don't trust the market overall. But when you drop like we dropped back in March, you buy that dip. So I'm done talking. Hope you all had a good day. Certainly a reminder to be utilizing stop losses, lows of Friday, key daily support, 4-hour rising wedge on the S&P 500 futures, but we're close to breaking bearish from that pattern. Need to see these futures shift momentum soon. And we are going to be looking towards earnings mid to later October as far as tech sector weekly confirmed downtrends or tech sector bulls looking back up to the all-time high resistances. Very big difference as far as how we are going to head into the end of 2020. Have a good rest of your day. Do good things. See you soon.